Hey, welcome back, everybody. This is Squawk Box on CNBC Europe. I'm Jeff Cutmore. Nice to see you. European shares rose to 6.5-year highs on Friday, lifted by gains in the oil and gas sector. Oil heavyweights BP and Royal Dutch Shell helped sentiment on market talk of a merger between the two, while a flurry of takeover activity and robust results have produced rallies in the major markets. Does this trend continue? Greg Secker is managing director at tradersuniversity.co.uk and joins us to talk about the direction for the market. Greg, nice to have you. Thanks for giving us your time this morning.
Yeah, great to be here.
What do you see as a student of the markets, as we all are? How much further do you see this positive trend for equities running?
Well, it's incredible, isn't it? I mean, it's takeover activity right across the banking sector. We're seeing the FTSE on a relative basis is still relatively undervalued. PE ratios of about 13.8 as opposed to 15 lows. So we keep seeing the market bouncing. You've got the Dow breaking out despite the whole subprime mortgage business in the States is still breaking the 13,000 level. You've got the FTSE breaking 6,000, as you see on the screen there, 6,600 up 40, called up 37 across the bettors in Europe this morning. So, we continue to see things run. We saw the setback in February. We see it across the CAC as well. All markets seem to be bouncing. They seem to go through this 6-month period where they have a retracement technically to around their 200 period moving average line, and seem to bounce well and strongly. And we see markets relatively undervalued again in PE relative terms, and yet continue to run. It seems that the interest rate hikes have now been discounted in London markets certainly. And therefore the allure of pulling money out of cash deposits and into stocks seems to continue.
Is there much value in trying to be a stock picker in an environment where the bourses just keep going up? I mean, why not buy the market and sleep a little easier at night?
Yeah, that's a good point. Well, I think, it's always that contentious issue, isn't it, of valuation, growth and viability, and that seems to be what many of these funds are now going for, which is, it's just trying to get the balance right between, undervalued stocks, those which tend to be somewhat unloved, but yet have good growth potential. We see some of those funds across Europe. We were looking at the Allianz funds only last week, the one which looks for innovation in tech stocks, those which are relatively undervalued to their sectors, which have ongoing and relatively strong growth. Take the Allianz funds, I think they had a 6-fold return just in obviously in acquiring Apple into their fund, and have done pretty well with other stocks similarly. But it's always that tough cross section between undervalued stocks and those which promise decent growth.
Hey Greg, this is Ajay Kapoor from First Horse Capital. I'm wondering what worries you, what could go wrong with this happy scenario?
Well, there's always the interest. There's always the big question of recession and stagflation in the States. We keep hearing this. There seems to be less analysts now are considering recession. We seem more and more joining the bullish side. We look continually at interest rate concerns. They seem to be discounted across all markets. We watch the commodities run that we've seen that's been bolstering the mining sector continues to run. We see commodity prices on copper up still. So we're still seeing a run across the mining sector. Oil sector, if you look at BP over the year, downtrend has been broken. And so we're seeing that there's been a push both up and down. Operations in the oil sector continues to run quite strongly. So whilst we are taking a relatively pragmatic view on the markets, we have a lot more longs on than we do shorts. And obviously, we try to be as balanced to the market as we can. We run a trading floor in London, and we try and keep a balanced view on what we're doing. But mostly we're long currently, and as the market continues to run, we'll take that stance.
Technically, there are a number of the analysts that we have who see us looking for 5 to 10% pullback.